Market gives up opening gains to trade flat. In fact, in the red, energy and autos lead decline, while the broader market sees a cut of about 0.5%, underperforming the frontline indices.
0.5% of equity changes hands. Sources tell us here at CNBC-TV18 that Wobgo Pincus is likely to have sold stake via Hydel Investments at around 108 rupees per share.
Insurance stocks surge after the government clears new commission regulations. Commissions paid will now have to be within the limits of expenses of management. PB Fintech is the bigger beneficiary, up 1%.
All Cargo and KWE signed a share purchase agreement for acquisition of 30% stake in the JV that they had for a sum of around 400 crore rupees.
Good morning. You're watching us here on Chartbusters on CNBC-TV18. I'm Manglam Malu. With me, as always, Nigel D'Souza. For time again, we've seen the markets move higher, and at higher levels, we have been facing some sort of supply. In fact, today's sell-off was a little more vociferous than what we've seen over the last couple of trading sessions. And now we are around that 16,950 mark on the Nifty. The question arises once again, can we see support at the 16,750 to 16,850 sort of zone? Currently at the low point of trade, led lower not only by the banks, which have been underperforming, but now the IT pack also comes in for a bit of a sell-off. We have Tech Mahindra at the low point of trade. The IT index as a whole is lower, and Reliance too, not helping the cause of the market. Hi, Nigel.
Well, I'm Manglam. We have the EPFO interest rate as well. That used to be, I think, 8.5% odd. Last year, it came down to around 8.1%. There's a marginal hike that we are seeing. It's been fixed at around 8.15% odd. So that's an important alert that comes in there. Well, for the time being, though, let's get in our technical expert to get a quick check on the markets. Manish Hathiramani joins us. Hi, Manish. Good morning. Manish, what are you advising your clients? The markets seem to be selling on any kind of bounce. What is your advice? Do you believe we can see a short covering bounce? There is some short covering that has happened, but it's not reflected in the stock prices or in the index prices.
Good morning, Nigel and Mangalam. Thank you so much for having me on the show. Well, I continue to believe we are in bear territory. And if you see recently, we had this mild up move, which went up to the levels of close to 17,000 from there. That's not a coincidence. The reason for that is because we have now turned range bound, and the lower end and the upper end is 16,900 and 17,200 respectively, at best 17,250. And now if we break 16,900 with this particular down move, we will go down to 16,650, 16,700.
All right, 16,650 to 16,700 is what you're eyeing on the frontline index. A word on the Nifty Bank, Manish, before you talk about your individual stock picks?
Because in that too, what was coinciding with 17,200 on the Nifty was about 40,200 on the Bank Nifty. And that's turned from, we are again range bound over there as well. So give or take a few points, we would be looking at about 30,200, 39,200 to be precise at the lower end of the range.
Okay. And what do you have in terms of individual stocks for us? The mid-cap index is underperforming.
I'm working with two frontliners. The first sell is on ONGC for a target of 145, stop loss of 154. The stock has broken the support of 154 on the back of good volumes. This should allow it to achieve a new short-term low. The second sell is on Axis Bank for a target of 815, stop loss of 850. This stock recently met with its resistance at 60, and that's where we've turned from. We also have an inclining volume pattern with a drop in price, which is a bearish signal.
Okay, all right. Thanks a lot, Manish, for stopping by and filling us in with your views as well as stock-specific information. Well, keep an eye on the index. Actually, we have moved even lower as we speak. We are testing the 16,950. Positioning is such that in the near term, that's today and tomorrow, we should hold out that recent low. That's around 16,840 odd. We're moved to the low point of the day. Risk reward could favor buyout here, but we're not getting follow through. So that is a bit of an issue. At higher levels, you're getting a lot of supply. The Adani Group stocks, they have come in for selling, which is giving you a bit of an iffy feeling, Mangla.
Yes, Nigel, and you know what's interesting is that in the second half of trade, we will also have the mid-cap index weekly options expiry. It's the first time that's happening. So it will be interesting to see how that plays out as well, because right from the word go, it's the mid-cap index which is currently underperforming, down by about 0.5%. Even when the index was higher, the frontline indices were higher, the mid-cap index was lower. And as we speak, the advanced decline ratio far and wide, we have nearly 2,000 stocks declining for every 800 stocks which are advancing. So if you just take a look at, you know, the way the crisscross lines are, they haven't, after the first criss and cross, they are the widest point apart from each other. And what's also not helping us is the fact that Brent is back to 78.
Yeah.
You know, when the global cues weren't in our favor, the only thing that supported us was Brent closer to $72, $73.
All right. Let's get in a couple of stock ideas then. It's a good time to shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Neha Dave of moneycontrol.com joins us to talk about a stock that she's tracking rather closely. Neha?
Today's stock pick is ICICI Lombard General Insurance. The growth in gross direct premium income for ICICI Lombard was higher than the industry growth in the first 9 months of the current fiscal, which improved its market share as of December end. Along with organic growth, the acquisition of Bharti AXA has also helped ICICI Lombard to consolidate its market position as the second largest general insurer. While the motor insurance, which is the largest segment for ICICI Lombard, saw muted business, health insurance was the key driver of overall growth. Since health insurance segment has a higher profitability as it has lower claims ratio as compared to motor insurance, the ICICI Lombard's combined ratio trended downwards in the current fiscal. Management indicated that combined ratio can go down further in FY24 as the investment made towards enhancing the distribution network will start getting reflected in the form of lower expense ratio. All this put together implies that return on equity, which has moderated to mid-teens from around 20% in the previous fiscal, can start improving from FY24 onwards. In terms of valuation, the stock is currently trading at around 5.3 times trailing book value, which undoubtedly is rich despite the price correction. However, since general insurance is a structural growth story, investors can keep this stock on their radar.
All right, Neha, thanks a lot for that. We'll step into a short break. On the other side, we'll be focusing on a bunch of stocks which are in focus, Hero MotoCorp, Royal Orchid, and we'll tell you why these stocks are buzzing.
Welcome back. You're tuned into Chartbusters. You're on CNBC-TV18. We'll be talking about the headline index. You know, plenty of stocks are falling off the cliff. Just pull up ACC and Ambuja Cements. They put out big projects. Achieve that guidance that they have put out because ACC's moved to the day's low. Ambuja Cements as well has taken a bit of a knock. And Shoba, the stock that's got hit that income tax rate news came out, the stock continues to reel under pressure. So I think it's down close to. But let's focus on a couple of other brokerage notes. Kotak Institutional Equities, well, they have issued a reduced rating on Hero MotoCorp. Fill us in with details of that report. Sonia?
So thanks a lot for that. I mean, you know, this note doesn't have anything new that we don't know about already, but there's definitely caution that continues. And that's perhaps the reason why this cut their target price. Kotak Institutional Equities has cut their target price on Hero MotoCorp to 2,400 and say that things have not gotten better. In fact, there are the same problems, you know, continued increase in cost of ownership, weakness in rural demand, soon which could hit demand further, and higher inflation, which is hitting pockets as well. But the other big trigger on the downside for Hero MotoCorp is the launch of the 100cc bike by Honda. Remember, the 100cc segment is a segment in which Hero Moto has dominance. And the fact that Honda has launched in this segment at a very aggressive price point is something that's making the street very nervous about whether Hero can retain its dominance in this segment. Overall as well, if you look at it, the domestic motorcycle market share of Hero MotoCorp has come off quite a bit. It's still the major market leader, but the market share has come off from 53% in FY16 all the way to about 46% in the 9 months of this year. It's also losing market share in a lot lot of key geographies, whether it's southern India, in Bihar, in Maharashtra, etc. So that is the big concern that the street has with respect to whether in the one segment that Hero has dominance, it's losing further share, which is the 100cc segment, which in any case has been faltering because of, higher costs. Now the new emission norm costs will kick in from the 1st of April. Once the subsidies on EVs are taken away, then that's a segment that will continue to get hit as well. So all in all, not looking too good, and a cautious report coming in from Kotak Institutional Equities.
All right, some caution, the stock at the low point of trade. But staying with brokerages, this one comes in from Nuvama, and this is on Royal Orchid, a relatively lesser tracked stock. They've initiated coverage on the stock with a buy rating and a target price of 400 rupees, which implies a near 90% plus sort of upside. And that's got the stock excited, up 7% in an otherwise extremely weak market. So what is it that they're saying? Well, we've been talking about how the industry is currently at a cusp where supply is likely to be lower than the demand, as a result of which the occupancy will aid the business, because all of these companies have a high operating leverage, which means that a high component of fixed costs, and any increased amount beyond that goes directly into their bottom line, as a result of which revenue growth is extremely crucial to track here. Edelweiss believes that given the situation right now, these guys can outgrow all the peers and grow at around 46% CAGR over the next 3 years. The average room rate, of course, is about 11% over pre-pandemic levels, so 111% of the pre-pandemic levels. And as the company's revenues grow, ARR grows and occupancy grows, the operating cash flow, which is the most important metric to track in hotels, will triple from close to around 39-40 crores in FY22 to closer to 100 crores by FY25. And you do your valuations basis that, the stock seems attractive, and as a result of which, seeing a 90% upside from current levels.
All right. Well, one of the rare stocks that are well in the green today and holding in the green, up close to around 7% odd. But gas prices, they're expected to be revised on the 1st of April. Sonal joins us to fill us in with more details on that front. Sonal?
Well, yes, as always, 1st April will be the day when domestic gas prices, they will see a revision. But this time around, there's a twist, because we did see the Kirit Parikh recommendations come by last year. And there is a possibility that Cabinet is set to adopt that report this time instead of the formula that we go by every year. So this is scheduled on Wednesday as per a Mint report. And if they do actually adopt it, it will be a game changer, because usually do it by the formula. But if we go by the Kirit Parikh recommendations, which recommended $4 to $6.50 per MMBTU as the range in which gas prices would be. The ceiling was at $6.50 per MMBTU, the floor at $4 per MMBTU. It was basically done to ensure that gas price hike does not impact consumers, and also at the same time the gas producers are not impacted by lower gas prices. They also had additional recommendations come by where they said 1st Jan 2027 will see complete liberalization of gas prices, which is not done as per market pricing right now. Difficult fields should see liberalization by 1st Jan 2026. New fields, they will continue to enjoy marketing freedom. This formula is actually applicable only for the older fields. Now, if this actually happens, it will be positive for gas users because we did speak to MGL and IGL earlier. They did say that 1st April should be the day when Kirit Parikh committee outcomes should be in place, and that is what they are waiting for. IGL said that if it comes by and it is actually adopted, it will lead to a fall in gas prices by $1 per MMBTU, which will be, of course, positive for them. And both MGL and IGL said that any sort of price hikes, any revision will be done only after this outcome is there, and that is something that they are waiting for. So we'll have to see whether we go by the formula or whether these recommendations are adopted, because if they do, it would definitely be a big change in the gas regime.
All right, Sonal, thanks a lot for that. So that's about the gas markets or the gas prices, which turn into or about to change from the turn of this financial year. Take a short break, come back, more news and updates to follow. Welcome back. Let's take note of the insurance space. The IRDAI, which is the insurance regulator, has cleared the commission regulations for life, general and health insurance players. What does it mean for listed players? Yash joins in.
That's correct, Manglam. It's a big development and a positive one for large life, general and health insurance companies, as well as for web aggregators like Policy Bazaar. Of course, PB Fintech is the listed entity there. What the government and the insurance regulators have done is that they've said that we'll have a headline expenses of management limit, and the commission limit could be under that headline expenses of management limit. Now, so far, there were different commission limits for different segments of business. Like motor will have a particular limit, health will have a particular limit. But now those segmental limits have been removed and a headline limit has been given saying that the commissions can remain under the total EOM or expenses of management. Now, just to have more clarity, what is expenses of management? It's essentially a sum total of two things, commission and fixed expenses. So now it will be up to the company to decide if they want to pay higher commission in one segment or more segments, then their fixed expenses will have to be reduced to stay under the headline limit, or vice versa. This will give flexibility to, of course, large insurance companies to sort of plan their commission better if they want to grab market share in one particular segment, to increase commission accordingly and reduce fixed expenses in that particular accordance. Why is it positive for web aggregators? Because if higher commission is being paid in a particular segment, it eventually that commission goes to agents and web aggregators like Policy Bazaar. So, of course, positive for them as well.
Okay, thanks a lot for that, Yash. Well, the paint sector is coming in for a bout of competition. Now, with incumbents expanding their capacity while new entrants are on their way as well, what lies ahead for the paint industry? Well, Manglam has gone across to the big ball to give us a special report. Manglam?
From हर घर कुछ कहता है to जब घर की रौनक बढ़ानी हो, the paint industry has been an incredible supporter of the India's home improvement sector. Let's take a look at the interesting insights and trends in the sector, which until now was seeing status quo, but a lot of competition as well. Status quo means 59% of the market share is with Asian Paints, followed by Berger at 18%, Kansai Nerolac at 15%, and Akzo Nobel, the makers of Dulux paints, close to around 7%. This has largely been the case for the last many years, give or take a few percentage points, but now there is a lot of supply coming in. The paint industry in India is expected to add 2.5 million kiloliters. That's the capacity addition in the next 3 years, which is currently, it's about 20% of the current existing capacity. The total capex outlay for the industry as a result of which this stands at 20,000 crores, 50% of which will come in from the big boy Grasim, and Asian Paints also, fearing this, has amped its capacity expansion up with 8,000 crores committed, and the others talking about 2,000 crores. When it comes to investment distribution of this money, Jefferies reports that 80% of this actually goes into building the plant and working capital, whereas 20% goes to building the distribution as well as the branding, etc., which is accounted for in the P&L. Let's talk about the tall targets that new guys are talking about. Grasim targets to be the #2 player after Asian Paints. JSW Paints also putting in serious monies there, aims to capture 10% of the market share by FY26. Nippon Paints, which is already the #2 player in Tamil Nadu, is eyeing Karnataka, and big targets coming in from relatively small players like Kamdenu, as well as investments coming in for Shalimar as well. If you just move forward and look at the situation right now as far as capacity is concerned, Asian Paints' current capacity, close to 1751 million litres, will increase to 2636 post its expansion, so near 50% jump out there. Berger Paints too, current capacity at 620 million litres, will increase to around 1100 million litres post expansion. Indigo Paints, a relatively new player in the industry, also eyeing a near 20% expansion in its capacity, and 290 crores have been committed by Kansai Nerolac in increasing its capacity as well, which currently stands at 600 million litres. Remember, for the paint industry to see so much supply, the question is there enough demand? Perhaps yes, and more, because the industry experts expect the demand to grow at an annual pace of 11 to 13%, which is about 1.2 to 1.5 times the GDP. It all boils down to two things in who wins the market in the paint industry. It's distribution and marketing. As far as distribution is concerned, Asian Paints is head and shoulders above everyone, just like in capacity as well. 75 to 77,000 distributors in the country, whereas Birla White, through its cement, has 54 to 55,000, 70% of which are actually also a part of the paint network. Similar numbers for Berger and Kansai at 31 to 35, whereas for Akzo Nobel and Indigo, it's anywhere between 15 to 18,000 dealers. It's worth noting that 70%, like I said, of Birla White's dealers are part of the paint network. Finally, let's talk about the spends on advertisement. Incumbent players have ad spends of less than 5% of their sales, whereas JSW spends anywhere between 15 to 20% on advertising. As per Jefferies, all this data raises some interesting questions for us to ponder. The first one, will incumbent players continue to hold forth through brand and distribution strength? The second one, can new players actually manage to gain both margins and market share? Third one, are lower margins the new norm for the paint industry? And the fourth one, could there be some M&A action in the industry? And finally, for all investors, the question is, should heightened competition lead to PE derating for the industry? Because for the longest time, these companies have been trading at extremely elevated valuations.
Interesting piece, Mangalam. Thanks a lot for that. For the time being, though, we'll have to wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next.